If you're losing trades like this, it's because one of these factors. The good news is that if you pay close attention until the end of the video and you follow along, you will be capable of getting these setups. So let's jump right into it. We're starting with the Nasdaq. First, we need to have an idea of what the market has done recently. This will help a lot in recognizing what has worked and what will likely work in the near future. For example, here we've started from an initial small uptrend, right? Notice the higher highs and higher lows. But then the market gained massive bearish pressure and printed a multiple chain of bearish candles. And all of these candles are continuation candles, meaning they have larger bodies and smaller wicks. So having bearish continuation candles and knowing that simple theory, we should know that the trend is likely to continue. And since the trend is a recently reversed downtrend, that's where we will focus. The trend reversed since this chain of bearish candles broke down below the last higher low, this forming a lower low. And the first lower low from an uptrend is a market structure shift. It's basically the validation that the market has officially entered into downtrend territory after breaking the lows. And the most likely scenario is the market forming lower highs, followed by lower lows, so essentially continue the trend. Now on downtrends, the market pulls back to the upside, but these are mostly pullbacks that usually just move to the upside only to fill a potential supply zone or an imbalance, seen on this time frame or seen on another time, which basically is just an entry structure from where the market often rejects to the downside, eventually going down to break the previous lower lows in order to create new lower lows that validate a bearish break of structure this time. So we first have the market structure shift, then if the trend follows its rules, we'll then have breaks of structure towards that trend, in this case a bearish trend. And this process repeats. That's what is called downtrend continuation. So pull back to the upside to fill a supply or an imbalance, followed by a rejection to the downside to form lower lows, and validation of the break of structure. But now here we're seeing something interesting. Because the market can't just go down forever, at some point it will break above the past highs. In this case, a break above the past lower high, which forms a new higher high. And when we're coming from a downtrend, a break of the past high into a higher high is the bullish market structure shift. It's basically the same story, but just reversed to the other side. The market structure shift, reversing the trend from a downtrend into an uptrend. On an uptrend, we expect a continuation of higher highs and higher lows, which we see right here, with the market pulling back down to form a higher low, which also coincides with retesting this support. If you're a breakout trader, that's probably what you're looking for. But anyway, after retesting, it bounced back to the upside by pushing into higher highs, breaking the past highs. So we have the first bullish break of structure right here. So now we repeat the story. We would now expect a higher low to form, and the higher low should hit a demand zone. And in that case, we will take the market into new highs with a buy-long position. Pretty simple setup. But we just need to find the opportunity first, because it might take a while, but that's why patience is crucial in trading. This time it happened fast, on the few next candles. Notice the pullback, and the push to the upside. Move that breaks the past highs, validating the bullish break of structure, so it also must have validated a demand zone. So pay close attention to the current price, basically where the price is at right now here. If you look on the left at this exact level, you can observe a demand zone, taken from the last downside candle before the upwards impulse. So this the price sitting right now on the demand. We position a setup, a buy-long position, stop loss below the demand, also coincides being below the lows, and take profit above the recent highs. Basically as an expectation to form a bullish break of structure. You can also manage the levels to suit your risk-reward preference. However, make sure to keep a sustainable risk-reward, not too high, but also not too small. Now we just have patience for the market to do its thing. Bullish pressure increasing, and that was a close one. Almost got stopped out, but turned out as a winner, so no problem. The market did a similar move actually, just another upwards push to break above the last highs. Then here we also got a small pullback, which was quickly followed by a higher high, so it broke above pretty fast. But this can also validate a demand zone. So let's actually take a look and plan a setup here. The positioning is similar. The entry on the top of the demand. Stop loss below the recent lows. Or you can also go lower if you consider that this demand is too small and the market might do a quick downside wick even if you might be right, and that wick could stop you out of the trade. But in this example, I will keep it just as normal, like before, with the take profit above the highs, somewhere around this level, expecting a break of structure to the upside. So here it broke above before filling the demand. This slightly decreases the quality of this demand, because this move itself forms another demand, which is found near this level. Cause from the pullback, and then upwards continuation into new highs. And if we look closely, the price has already filled this demand. So let's actually see if this works as well. This was a quick win, however a smaller risk reward, but a win is still a win. Now we won't look for another setup, because one is already pending down. Be careful to not overtrade. Here as well, we have another higher high, so it validates a new break of structure, decreasing the value of this lower demand even more. And yes, that was a loss. It broke straight down after filling the order. But that's why if the market forms a new bullish break of structure, we should look for the new demands and invalidate the ones below that are far away from the current price. So let's continue this analysis because something interesting happened from this super bearish move. We started to form lower lows and lower highs once again. Here we got the lower low internally on this small move, which flipped the internal trend from an uptrend into a downtrend. But the external trend was still not bearish at that point. But it has reversed on the external level, or swing level, only after it has broken down below this low. This is the actual bearish market structure shift. So now we're coming back into the same story as we had in the beginning of this market. Basically an uptrend that reverses into a downtrend. And here we don't have any significant supply zone to sell the market down. The only bearish entry structure here might be this imbalance. However, it doesn't look the highest quality one. And it hasn't filled anyways, because the market is pushed down very aggressively afterwards. This probably won't fill anytime soon, so we invalidate that imbalance. And this is enough on this market. We've got 3 trades, 2 wins and 1 loss, with positive risk-reward ratio on all trades, ending the session on Nasdaq on net positive, now into the next market. Now on the Nvidia stock, this works wonders for stocks as well. Here we're starting from the 5-minute chart, just so we are able to see the higher time frame trend, which looks to be a downtrend because we see the lower highs and lower lows. However, look at the last candle, a very bullish candle with huge buying pressure. And this candle broke above the last internal high, forming an internal market structure shift. So this indicates that the lower time frame trend, the internal trend, has reversed into an uptrend. But keep in mind, the high time frame external trend is still bearish at this point, and we have 2 scenarios. The market can break above these highs and reverse into a high time frame uptrend, from where we can look for a demand zone to take the market higher with a buy position. Or the market can break the swing lows, which would validate a bearish break of structure, situation in where we look for a supply zone to take the market into lower lows with a sell position. We wait to see what the market does and we react after. We can also see more in-depth data and have a more clear view by zooming in. So as an example would be to move down into the 1-minute chart, just like the other market from before. And this is what we see for now. We need some patience to see how the market reacts, which in this case it reacts by forming a downside pullback. Then it follows by pushing the market higher to break the last high. And having formed a bullish break of structure, it also validates a demand zone. Demand that is usually found near the higher lows, around this level, and just as usual, planning the setup. Stop loss below the demand. Take profit above the highs. The bearish pressure is increasing, which is a good sign because it pulls the market down into the demand. Now the order got filled here. We're consolidating so far, and looks like this is going to jump higher. Yes, closing as a win. This shouldn't be complicated, as it is not, because it's just like the saying of buy low and sell high. And after breaking into new highs, the market pulled back down for a short time period, then quickly reversed back up, breaking into new highs. So another break of structure, which validates a demand, however a very small one. So once again, entry on the demand, stop loss below the demand, take profit above the highs. This has a slightly higher risk-reward ratio, but it invalidated because the market just went straight to the upside very aggressively without any significant pullback. And this move itself formed new demand zones. However, they also did not get filled, because the market just had too much buying pressure. Keep in mind, not all demand or supply zones fill, just like how not all demand zones and supply zones respect. But what we care the most here is moving into the most recent price action. The more recent, the more accurate. And for example, there is a forming demand right here, being the last bearish candle before the upside impulse. However, it is not yet a validated demand because it did not break above the highs. But it looks like it's getting close there, and if you're a more risk-seeking trader, you can find some situations where this might work. But if you're more risk-reserved, then validate the demands only after the market forms the break of structure. See, it did not fill, because the market has continued pushing higher. So we cancel that plan. A missed trade is better than a loss. Now if we look closely, it's near the lows. The market needs to close above this level in order to stay bullish externally, on the swing levels. Basically to form a higher low. It continued higher, into new highs, but then it pulled back down, and this pullback eventually broke down below the last lows. Because keep in mind that after a bullish break of structure forms, the swing low becomes the lows from above. So they would be these lows, which it just broke to the downside. This being a bearish market structure shift. So now the trend has reversed, from an uptrend into a downtrend, by forming lower lows and lower highs. And after each lower highs, we form the bearish break of structure. On downtrends, we look for supply zones, and supplies are found on the lower highs. The first important one being here, which is exactly where the price is sitting right now. So planning the setup, sell short on the supply, stop loss above the supply, take profit below the lows. But you can also transform this into an intraday setup. For example, if we look on the left, we need to question what levels look to be good exits. The market usually bounces up from a demand, so a very smart placement of the exit is right on a demand zone. The market is currently right on a demand zone, for example, but because of the market structure shift, this demand will likely break down since the market has reversed just recently. So we look for the demand below. Should be this one here, and the risk reward is also great. Now we have patience. This time was quicker than I expected. The bearish pressure was just so high that it pushed into a lower demand. On this market, if we're zoomed out, we see this slow down trend which pushed down aggressively near its end. But then it reversed back up pretty fast. This upside push broke above the last swing high. Being the confirmation that this market has reversed from a downtrend into an uptrend, we look right before the break happened. We have a demand zone, basically being the last downside candle before a massive bullish candle formed. Now if we see, this demand has already filled and has already worked out, we've missed it, but that's just to show you that this works well. After filling the demand, the market pushed above the first internal high and also above the last external high. So now we look for a new demand. The next one is here, but it's also a very small zone. But let's give it a try anyway. Stop loss below the lows. Take profit, we can't place it here above the highs because the risk-reward ratio would be way too high. Around this should be most I would target. And yes, we're still expecting higher highs, just like it is done before. But if the risk-reward is just way too high that becomes unsustainable in the long term, we can also look for more details. What I've seen is that the market here, it broke down below these lows. So this would be a bearish market structure shift. But at the same time, the market broke above the highs. So it didn't form lower highs. But it has formed higher highs. Coming into a conclusion, if both rules did not respect for a buying setup to validate, meaning a higher low and a higher high, then we do not take the risk and we look for another opportunity. See how it formed lower highs here and lower lows here. This is bearish. There it is. It continued lower and here even lower, forming lower highs and lower lows from this super aggressive movement to the downside. It also broke below another high time frame low. Being a bearish market, we look for sell short opportunities. Here we got some small pullbacks, but it faded down quickly, breaking into lower lows. Nothing unexpected so far. It's only here that the market formed this sort of consolidation. You might see this as a resistance. And here as a support. Here we have two scenarios. It breaks up, pulls back to retest. allowing us to look for a demand and take the market higher with a buy-long order. Or the second scenario, it breaks the support, we wait for a retest, and look for a supply zone as an opportunity to sell short into new lows. So let's see which one plays out. Looks like it has broken down with the second scenario playing out. So we identify the supply zone, entry on the supply, stop loss above the supply, take profit below the lows, basically expecting a break of structure. The order filled, nice, beautiful rejection. Also, don't forget my trading program. It's a road from A to Z step by step, straight to not only being profitable, but most importantly on how to sustain it for the long term. You can check it on the link in the description, and see you on the next video.